$47. That's the price of silver today. But by the time you finish watching this video, you'll understand why that number is about to become one of the most important figures in your financial life. And if you think a metal sitting in a vault somewhere has nothing to do with your savings, your retirement, your daily cost of living, I need you to stop what you're doing and listen very carefully to what I'm about to tell you. Because while you were focused on the stock market, while you were watching interest rates, while you were worrying about inflation, something happened in Washington that Wall Street did not want you to see. Something that the largest financial institutions in the world are furious about right now, today, not in theory, not projected, actually furious. Behind closed doors, in emergency meetings, making phone calls they don't want recorded, Trump just signed it. And silver just got a legal status that it has never had in modern American history. A protected asset designation that changes everything, not just for silver, not just for precious metals, but for the dollar, for your savings, for the entire financial architecture that your retirement is built on. And this isn't speculation. This isn't a theory from the internet. This is documented, signed, legal, and already triggering a reaction from the institutions that have spent decades making sure you never thought about silver seriously. By the end of this video, you will understand exactly what was signed, why it was signed, what history tells us happens next, and most importantly, what you need to do before the people around you even hear about this. Stay with me, because the next 25 minutes will change how you think about money forever. So let's talk about what actually happened. Because the mainstream media is either ignoring this completely or burying it so deep in financial jargon that the average person never understands what it actually means. And that's not an accident, that's a choice. Here's what was signed. The executive order legally designates silver alongside gold as a protected monetary asset under federal financial law. What that means in plain English is this: silver can no longer be treated as just a commodity by federal institutions. It cannot be freely manipulated, suppressed, or liquidated by government agencies the way it has been for the last 5 decades. It now carries legal protection that separates it from copper, from oil, from wheat, from every other raw material that Wall Street trades like a poker chip. Now, why does that matter? Because for 50 years, the big banks have been running a system where paper silver, contracts on silver that don't actually exist as physical metal, outnumber real physical silver by a ratio that would shock you. Some estimates put it at 250 paper silver contracts for every single ounce of real silver in existence, 250 to 1. And that system only works as long as silver stays classified as just another commodity. The moment it becomes a protected asset, the rules of that game change overnight. And Wall Street knows it. That's why they're furious. That's why the phone calls are happening. That's why you're seeing unusual movement in the silver futures market right now that the financial press is completely failing to explain to you. This wasn't a small policy adjustment. This was a direct strike at the foundation of how banks control monetary value in America. And the consequences are only beginning to unfold. Let me show you the math. Because this is where it gets uncomfortable for the people who've been telling you silver is just an industrial metal with no real monetary significance. The numbers tell a completely different story. Right now, the gold to silver ratio sits at approximately 88 to 1. That means it takes 88 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged 47 to 1 over the last century. In nature, silver exists in the Earth's crust at a ratio of approximately 17 to 1 relative to gold. So the market is pricing silver at 88 to 1 when nature produces it at 17 to 1. That gap is not natural. That gap is manufactured. That gap is the result of 5 decades of systematic suppression through paper contracts, futures manipulation, and institutional short positions that dwarf the actual physical supply. But here's what makes this moment different from every other moment in the last 50 years. Silver is no longer just a monetary metal. It is now the most industrially critical metal on the planet. Every electric vehicle requires between 25 and 50 grams of silver. Every solar panel uses approximately 20 grams. Every artificial intelligence server chip requires silver in quantities that the industry is only beginning to calculate. Global solar installations alone are projected to consume 200 million ounces of silver annually by 2027. Now here's the problem. Annual global silver mining production is approximately 820 million ounces. Industrial demand is already consuming over 50% of that. Investment demand hasn't even arrived yet. When protected asset status meets a physical supply crisis, the mathematics stop being a debate. They become a verdict. Now here is where most people stop and say, okay, this sounds serious, but how do I know this isn't just political noise? How do I know this actually changes anything? And that is exactly the right question to ask, because the answer is sitting in 500 years of documented financial history, and it is not subtle. Every single time a government has made a dramatic legal shift in the status of precious metals, It preceded a massive currency event. Not sometimes, not usually, every single time. And the people who understood what that legal shift actually meant walked away with their wealth intact. The people who dismissed it as politics, as noise, as temporary disruption, lost everything they had built. Not some of it, everything. There's a pattern here, a financial pattern that is mathematical in its consistency, documented in public records, verifiable in historical data that you can look up yourself. It has 3 distinct stages. The legal trigger, where a government action changes the rules around precious metals. The institutional reaction, where the smart money moves quietly, systematically, without headlines. And the public awakening, where the majority finally understands what happened, but by then it is too late to act at the prices that existed before. We are in stage 1 right now. The legal trigger just happened. Stage 2 is already beginning. The institutional reaction is visible in the data if you know where to look. And to prove to you that this pattern is real, that it is not theory, that it has played out identically 3 times in modern American history alone, I need to take you back. First to 1933, then to 1971, then to 1980. Because what happened in those 3 moments is happening again right now. Franklin Delano Roosevelt is sitting in the White House, and America is in the middle of the greatest financial crisis in its history. Banks are failing. Unemployment is at 25%. The dollar is under existential pressure. And FDR does something that nobody saw coming, something that the financial establishment told the public was temporary, a one-time emergency measure, nothing to worry about. He signs Executive Order 6102. And overnight, it becomes illegal for American citizens to own gold. Not discouraged, not taxed, illegal. Citizens were ordered to surrender their gold to the Federal Reserve at the government fixed price of $20.67 per ounce. Comply or face 10 years in prison and a $10,000 fine. That's roughly $230,000 in today's money. But here is what they don't teach you in school. Silver holders were untouched. People who had positioned in silver before that order kept everything. While gold owners were forced to surrender their wealth at government prices, silver holders watched their metal rise. Within 12 months of Executive Order 6102, FDR devalued the dollar against gold by 40%. The people who were forced to sell at $20.67 watched the government immediately reprice gold at $35. A 69% theft in broad daylight, completely legal, completely documented. The smart money saw it coming. Not the public, not the politicians, just the people who read the financial signals correctly. The banking families, the institutional insiders, the historians who understood what government desperation looks like when it's dressed in emergency legislation. Same legal trigger, same institutional panic, same outcome for people who were positioned correctly versus people who weren't. Stage 1, verified, documented. And it happened again 38 years later. August 15th, 1971. Richard Nixon walks into a television studio on a Sunday night, interrupts your regular programming, and delivers an announcement that permanently changed the global financial system. He called it a temporary measure. He said it was necessary to protect the dollar. He smiled and told America everything would be fine. He closed the gold window, permanently. From that moment forward, the dollar was backed by nothing. No gold, no silver, no commodity of any kind. Just faith. Just a promise from a government that had already proven it would break its promises the moment it became financially convenient to do so. Now here is what the history books leave out. In the 24 months before Nixon's announcement, the smart money was already moving. European central banks had been quietly redeeming dollars for gold at the Federal Reserve. France alone pulled $191 million in gold out of American vaults in the years leading up to 1971. They could read the balance sheets. They knew what was coming. The public had no idea. What happened to silver after Nixon closed the gold window? In 1971, silver was trading at $139 per ounce. By 1980, it hit $49.45 per ounce, a 3,457% increase in 9 years. The people who understood what Nixon's announcement actually meant, who understood that removing gold backing destroyed the dollar's anchor completely, who positioned in real assets before the public awakened, those people did not just preserve their wealth. They multiplied it beyond anything the stock market offered in the same period. Same pattern, same legal trigger, same institutional movement before the announcement, same explosion in silver's value afterward, same result, every single time. 2 brothers from Texas are sitting on information that most of Wall Street already knows, but refuses to say out loud. Nelson and William Hunt, sons of one of the richest men in America, have spent years studying the same monetary patterns we just walked through. They watched what happened after 1971. They read the same balance sheets. They understood what a dollar backed by nothing eventually does to real assets, and they made a decision. They started buying silver, not paper silver, not futures contracts, physical silver. Hundreds of millions of ounces accumulated quietly, systematically, across multiple jurisdictions, stored in vaults from Switzerland to Chicago, By 1979, the Hunt brothers controlled an estimated 1/3 of the entire world's non-government silver supply. Silver moved from $6 per ounce in 1979 to $49.45 by January 1980, an 800% move in 13 months. And then the government intervened. Not slowly, not through legislation, not through public debate, overnight. The COMEX exchange changed its rules in a single emergency session. New position limits, margin requirement increases so dramatic that holding silver contracts became financially impossible for most participants. The intervention was immediate, surgical, and devastating. Silver crashed from $49.45 back to $10 within weeks. The Hunt brothers were financially destroyed, billions wiped out in days. But here is what that moment actually proved. It proved that when silver threatens the system, governments react with violence. It proved that silver's power is real enough to cause emergency rule changes at the highest levels. It proved that the people controlling the financial system understand exactly what silver represents. A direct threat to their control of monetary value. Same warning signs, same government panic, same pattern, every single time. Now, let me show you where we are today. Because everything we just walked through, FDR's executive order, Nixon's gold window, the Hunt brothers' silver squeeze, all of it was building to this moment. And the data is not subtle. The data is screaming. COMEX registered silver inventory, the physical silver that actually backs the paper contracts being traded every single day on Wall Street, has dropped to levels not seen since 2000. We are talking about a market where 250 paper contracts exist for every single ounce of physical metal. And the physical metal is disappearing from registered vaults at a rate that has no historical precedent in modern times. Meanwhile, industrial demand is accelerating in 3 directions simultaneously. Solar panel installations globally hit a record 430 gigawatts in 2024. Every gigawatt of solar capacity requires approximately 1 million ounces of silver. Electric vehicle production is projected to consume 90 million additional ounces of silver annually by 2028. And artificial intelligence data centers, the infrastructure powering every major technology company on Earth right now, requires silver contacts, silver conductors, silver components that cannot be substituted with cheaper alternatives. The supply is shrinking. The industrial demand is exploding. The investment demand has barely arrived. And now, sitting on top of all of that, protected asset status just changed the legal framework that allowed suppression to continue. Foreign nations are accumulating physical silver quietly. China increased silver imports by 73% in 2024. India's silver imports hit a record 4,972 tons in the same year. They are not buying paper contracts. They are buying physical metal and removing it from the global supply permanently. This is not a setup. This is not a prediction. This is documented, verified, and already happening right now. Here is what Wall Street does not want you to understand. Because if you understand this, you understand exactly why the fury behind closed doors is real, why the emergency meetings are happening, and why the institutions that have controlled silver's price for 5 decades are genuinely frightened right now. The big banks are short silver, massively, historically, almost incomprehensibly short. A short position means they have sold silver they do not own, borrowed silver they cannot physically deliver, made promises on paper that can only be kept as long as nobody asks for the actual metal. And for decades, nobody asked. Because silver was just a commodity, because the rules allowed it, because the system was designed to make sure that paper silver and physical silver never had to reconcile with each other. Protected asset status changes that equation completely. When silver carries legal protection as a monetary asset, the pressure to reconcile paper positions with physical reality increases in ways that the current short structure cannot survive. JP Morgan alone has faced multiple federal investigations and paid over $1 billion in fines for precious metals market manipulation. $1 billion in fines, and they kept doing it. That tells you everything you need to know about how profitable the manipulation was. But here's the number that should make every short seller in that market lose sleep tonight. The COMEX has approximately 840 million ounces of paper silver obligations outstanding. Physical registered silver available for delivery sits at approximately 140 million ounces. That is a 6-to-1 gap between promises and reality. And protected asset status just made that gap impossible to ignore indefinitely. They know what is coming. That is exactly why they are furious. Now, I know what some of you are thinking right now, and I want to address it directly because these are legitimate questions that deserve straight answers, not dismissal. The first one. Silver has been cheap for years. If it was really this powerful, why hasn't it moved already? That is exactly the right question. And the answer is that it hasn't moved because the suppression system we just described was working perfectly. Paper contracts, manipulated futures markets, institutional short positions, all of it designed to keep silver's price disconnected from its physical reality. The Hunt brothers proved that silver can move 800% when the suppression breaks, Nixon proved it can move 3,457% when the monetary anchor shifts. The suppression is not evidence that silver is weak. It is evidence of exactly how threatening silver is to the people controlling the system. The second one, the government would never actually protect silver. They just did. It is signed, it is documented, it is legal. The same people who said FDR would never confiscate gold were handing their gold to federal agents within 30 days of that statement. The third one, this is just politics. It will be reversed. Maybe. But the institutional reaction happening right now in silver markets does not wait for political reversals. The smart money is moving today based on what exists today. By the time a reversal happens, if it happens, the move will already be complete. And the fourth one, gold is better than silver. Gold is important. Gold is proven, but gold is already at $3,200 per ounce. Silver is at $47. The gold to silver ratio sitting at 88 to 1 tells you precisely which metal has more room to move from here. The math does not lie. It never does.